Here we are, 10 o'clock. It's time for our weekly webinar. Good morning, everybody. I'm really excited to see you. Here it is, Wednesday. This is our new schedule. It is Wednesday, June 12th. So that's exciting. It's been a couple weeks since I've had the opportunity to come to you folks, and I'm really looking forward to it. I've missed you. We had a couple weeks of hiatus for a couple reasons, but here we are. Let's talk about what we're going to talk about this week. So we're going to go through our normal schedule. We're going to have an update on some Slott Report material. I had a lot of material to go through, so I hope you like what I'm going to share with you. And then we're going to talk about the markets, a few headlines as well. We have the CPI headline this morning. And then we're going to go into our Financial 15. So our Financial 15 topic this week is going to be choose your retirement tax rate. So we have this unique ability to choose our tax rates in retirement. And we're going to talk about what that looks like and the tools and the resources, the timing, the planning that's involved and all of that. We're going to talk about that in the Financial 15 segment. So make sure you hang around for that, or if you're just coming to us on YouTube, you can scroll through and choose the chapter or the index that reaches the Financial 15. But that's going to be an interesting topic. It's something that we talk about often because you can choose your retirement tax rate for your lifetime and perhaps 10 years after your death or more. All right, and I just remind you that my goals for these webinars for you is just always stay inspired to make changes. Make changes in what you're doing today. If you're stuck in the old paradigm of tax-deferred investing, with the idea that taxes are going to be lower in the future, maybe you think you're going to be spending less in retirement. My experience tells me that's not the case, and there are many, many reasons why we believe the taxes have to be significantly higher in retirement. And it's not just about taxes. Right? It's about all these other planning techniques we talk about. So be inspired to look at things differently and make changes. Open your mind to allow you to look at things differently. You've got about 40 years maybe or 30 years of programming of certain things that you've heard from other financial planners, the representative of your retirement plan, things on, before YouTube or what you may have read in books. So, it's time to start looking at things differently, whether it's your tax planning, your financial planning, your investment strategies. These things have to be treated differently these days. Stay educated so you feel confident in that plan and strategies that are put in place, and be able to stay updated through that education to make changes as we need to going forward. And you've got this ability through this channel and other channels and other experts in the field. And I hope you're getting benefit from our expertise here, not just me, but from the team, but to stay updated, stay educated, stay open-minded, and stay inspired to make these changes. So they're my goals for you. I like to share those. We've got some big headlines this week. Of course, the CPI report came out this morning, just a little bit ago, and it was good news. So, from Barron's, they immediately published that the headline CPI increased 3.3% year over year in May versus 3.4% expected by economists. The index was flat month over month versus what was expected was a 0.1% growth. And then core CPI increased 3.4% year over year versus 3.5% expected in May. On a monthly basis, that index rose 0.2% versus 0.3% that was expected. So these numbers may sound really, really small, 3.4% compared to 3.5%, but it's a big deal. So when we see inflation trending down at all, that's going to be viewed as a positive. We're already seeing that in the market today. I'm looking over at my little monitor that has CNBC, and I see the headline says S&P, NASDAQ at record highs, and we've been hitting these record highs on a pretty regular basis over the past few weeks. But this is good news. Now we also had the Fed meeting today, and at the Fed meeting, they're going to tell us if they're going to cut rates or not, or when they're thinking about cutting rates. Folks, I still wouldn't get ahead of ourselves and think that we're going to see rate cuts anytime soon. Probably not until 2025, in my opinion, or maybe late 2024. But don't look for anything in July, I don't think, at all. So that is the CPI report. So it's June 12th. I just want to remind you that estimated payments for your taxes are due on June 17th. So if you're doing Roth conversions, it's a staple in our practice here to guide people through the Roth conversion process. And if you're not withholding, or if you're not handling your tax payments another way, then you should be making estimated payments. And the estimated payment date is June 17th. So pay attention to that and make sure you've got things set up, because you don't want to miss that date. And of course, you want to consult with your tax preparer on these issues. So let's dive into the Slott Report. I'm going to share my screen with you here. And you should see in front of you the Slott Report. And the first report that I thought was interesting was the Slott Report takes on AI. Huge topic, a lot of momentum in the stock market around artificial intelligence. You know, we use a program using artificial intelligence to review tax returns and estate plans. And I have to tell you, the progress I'm seeing in this program, or this platform, is really shocking how quickly things evolve. And we see it, you know, in all over with when we're using artificial intelligence, whether it's self-driving vehicles or updates of GPS or whatever it might be. But just witnessing it on a day-to-day experience with this piece of financial planning platform that we have. It's just one piece of what it takes to put together a financial plan for our folks, but using artificial intelligence for reviewing of those tax returns and estate plans, I've just seen it leaps and bounds in a short period of time. So that's really exciting. But read along with me with this. This is just from Monday, and this reads, "We are surrounded with information and misinformation. Finding accurate, up-to-date facts is increasingly difficult. Do an internet search and you will likely run into obsolete websites that have not been updated in years. Paywalls demanding you subscribe before getting access, and sites completely generated by AI with very limited human involvement. We at the Slott Report are the exception to this dismal reality. Several times a week, our retirement account experts, actual humans, write blogs tackling some of the most complicated issues affecting retirement accounts." Boy, I can attest to that. Not only as part of the Ed Slott Master Lead Advisor Group do I have direct access to these analysts on a regular basis, and I actually emailed Sarah, the person who wrote this, last night or yesterday. As I was meeting with a client, I just took a second and I emailed her a question, and it came back almost immediately. And that is just the kind of help and support that is so beneficial to our practice and our clients. I just can't say enough about it. And so if you're a financial advisor listening to this, and many financial advisors have started listening to this YouTube channel, and we've grown, by the way, since January when I did a presentation out in Scottsdale, Arizona. Our YouTube subscribers have grown by 2.5 times. So that's really exciting. It's still small in the space of YouTube, but it's really exciting to see more and more people subscribing and listening every week. Anyway, where was I? So here's where we are. We, actual humans, write blogs tackling some of the most complicated issues. I'm right here now. We get many questions about the Secure Act and its impact on inherited retirement accounts. We were curious how AI would handle these inquiries, so we asked AI the following question. How does the Secure Act affect inherited IRAs received by a non-spouse beneficiary? Here is the response from AI. They must be distributed within 10 years, regardless of the beneficiary's age. So the question was, how does the Secure Act affect inherited IRAs received by a non-spouse beneficiary? This is put forth through AI. The answer is not from the Slott Group, but it's a response from an AI, artificial intelligence tool. The answer was they must be distributed within 10 years, regardless of the beneficiary's age. So if you've been listening for a while and following along with these webinars, you may be waving your red flag saying, well, wait a minute. That's not necessarily the case. So I'm going to let Sarah explain what that means. At first glance, she writes, this may seem like the right answer. After all, the Secure Act did replace the stretch IRA with a new 10-year rule for many IRA beneficiaries. However, this is not the full story. Nothing in the tax code is that simple. Or not the truth. While the majority of non-spouse beneficiaries are subject to the 10-year rule, some are not. In fact, some beneficiaries are not subject to the 10-year rule specifically because of their age. Due to their age, some living non-spouse beneficiaries are eligible designated beneficiaries who can still get the stretch and are not required to use the 10-year rule. Examples include both minor children of the account owner and beneficiaries who are not more than 10 years younger than the deceased account owner. Non-spouse beneficiaries who are not living, breathing entities are subject to a completely different set of rules. The 10-year rule does not apply. Instead, those beneficiaries, such as an estate, would be subject to either the 5-year rule or annual distributions based on the remaining single life expectancy of the deceased IRA owner, also known as the ghost rule. AI can be a valuable tool, but it has its limits. Using AI might be helpful, but it can fall significantly short of providing all the important details, and what you don't know can hurt your IRA and your retirement. When it comes to accurate, up-to-date information on retirement accounts, you can count on the living, breathing humans who bring you the Slott Report to give you the full and accurate story. So great information from Sarah. Listen, I experienced this when I was doing the program for my daughter's school. So I shared with you before, my daughter invited me into her school. They wanted the honors program wanted to do a financial literacy program for college students. So I put that together, and I was having a lot of fun using artificial intelligence to help me put this information together. But not all of it was accurate. Even some of the math was inaccurate, and that was interesting to me. So that was quite an exercise. So the moral of the story is just be careful. There's a lot of good information out there. I use Google a lot. I use YouTube a lot. When I'm trying to fix something, I'll look it up on YouTube. But you've got to be cautious about where you're getting your information from. And again, YouTube should not be used for advice. I don't even want you taking advice from this channel. Education is great. YouTube is great for education. Advice is specific and very particular to you. So use this YouTube channel, maybe other YouTube channels for education to build up that knowledge so that you know what to look out for and things to raise red flags, questions to ask, however you want to treat it, or maybe just to stay up to date, stay inspired, all of those things. But don't use your YouTube tool as advice. Advice is very specific. So let's go on to probably my favorite part of what we do with the Slott Group, and that is the mailbag. So these are questions that come into advisors, CPAs, trustees, or from, advisors, CPAs, attorneys, I should say, and just the general public. So I always like this. So this first question is from a financial advisor, and this person attended one of the training events, the 2-day training events that Ed and his team offer. Which is different than the training events that members have to go to. But the question is, I attended the Mid-Year IRA Planning Opportunities 2024 webinar on May 14th. I missed the reason for not naming a trust as a beneficiary in an IRA. I know you can name a trust, but what would be the downside? And this is from Victoria. That is a great question. It used to be really common to name trusts as beneficiaries to your IRAs. There are a lot of good reasons for it prior to the Secure Act. The Secure Act took away a lot of those reasons. The answer is, Victoria, there are certainly valid reasons to name a trust as your IRA beneficiary. For example, good reasons would include the case of a special needs beneficiary, spendthrift or addiction issues, or if the beneficiary was or is a minor. But naming a trust is not always the best course of action. If a trust is the beneficiary, a trust-held inherited IRA would need to be established. And the trust beneficiary could have unnecessary restrictions applied to his or her access to the funds. Trusts introduce what could be totally unnecessary costs and complexity. Additionally, if there are multiple trust beneficiaries, payout rules like the 10-year rule or a lifetime stretch could be impacted. We just talked about that with the other report. Also, if IRA funds are paid to the trust and remain in the trust, now we are introducing the high trust tax rates to the equation. It is our opinion that you must have a good reason to name the trust as a beneficiary if the trust beneficiaries are otherwise healthy, mature adults, and if there is no desire by the IRA owner to control assets after death, then just name the adult beneficiaries directly on the IRA. Good answer. Next question. I have a client who has both an inherited IRA and a traditional IRA, both requiring annual required minimum distributions, or RMDs. My understanding is that their respective RMDs will need to be taken from each account separately. Does the same rule or logic apply to qualified charitable distributions, or QCDs? QCDs have become wildly popular over the past few years. A QCD, qualified charitable distribution, allows you to take money directly from your IRA and send it right directly to a charity without reporting it on your tax return or paying tax. So there are limitations. You have to be over 70 and a half, and there are some limitations. It's now $105,000 per individual can do that to cover distributions for RMDs. And I did say you have to be over 70 and a half. You don't have to be RMD age. The triggering date or triggering age is 70 and a half. That $105,000 is up this year, and it will increase with inflation. But QCDs have become wildly popular. Now back here. So let me help you find our place, because I went off on a little tangent there. So now we're here at if the client elects to make a QCD equal to the amount of the RMDs, will my client need to make a separate QCD from each IRA, or would she be able to aggregate the two RMDs and take them from one IRA, either the traditional or the inherited, as a QCD? Thank you, Brent. So the answer, Brent, you are correct that RMDs from a traditional IRA and inherited IRA cannot be aggregated. Each RMD must be calculated separately and taken from the respective account. Since these RMDs cannot be aggregated and taken from a single account, then separate QCDs must be done to offset both RMDs. Also note that even though this person has both a traditional and inherited IRA, she's still limited to the total annual QCD amount of $105,000 for 2024. So the RMDs have to be separate when you're talking about IRAs and inherited IRAs. Therefore, the QCDs, the qualified charitable distributions, have to be separate, and the aggregated amount between the IRAs and the inherited IRAs still cannot exceed the $105,000. I really like that letter today. Okay, now moving on to the markets. So we talked about, I'm going to first give you a review of what happened in the markets last week, and I'm going to pull up my report from our friends at Invesco. That is not a recommendation to buy or sell or hold any investments with Invesco, or anybody else for that matter. But the Dow Jones Industrial Average was up 0.33% last week. That gives us a positive return of 3.86% for the year in the Dow Jones Industrial Average. Now, the S&P 500 was up 1.36% last week, and that gives us a positive return of 12.81% for the year. Big difference between the S&P 500 and the Dow Jones Industrial Average. We talked a lot about those indices and how they're what's in them and what how they're structured in a different video, and now I have to include that video in my description. Video about indices. Okay, the Nasdaq was up 2.4% for an annual return. That was last week, for an annual return of 14.51%. The MSCI World Index, not including the U.S., all the other large stock, publicly traded stock holdings in the world, was up 0.35% for an annual return, year-to-date return of 7.51%. Emerging markets was up. The Europe, Asia, and the Far East was up. The only stock index that was down were global small companies. That was down 1.24%. Still positive for the year at 2.25. The bond market was up slightly. Boy, this has been a challenging market for the bond market. Bond market was up 0.44%, but the U.S. aggregate bond index, which is where most investors hold most of their bond money, is still down 1.21% for the year. So not terrible. It's not like it was in 2022 so far, but still, people see bonds as their safe investments. If you're just listening, I'm doing air quotes, as their safe investments, but that investment is down 1.21% so far this year. Okay, so what does some of our analysts say about all this? Let's read what our own analysts say first. Cornerstone. So looking at last week, we had the ISM manufacturing report. This survey of manufacturing sentiment fell a half a point to 48.7 in May. The forward-looking new orders component fell 3.7% Oh my goodness. 3.7 points. It did not fall 3.7%. It fell 3.7 points to 45.4, while the prices component fell 3.9 points to a still elevated 57. Solid 57. So the analyst writes that the overall economy continues to grow, but manufacturing activity appears stagnant, hovering around the neutral level. Higher interest rates are likely weighing on the group, but the price component losing ground will be viewed as signs of progress by the Fed. So the Fed wants to see this. They want to see some slowing in really across all sectors of the economy, but that's what they want to see to help dampen inflation. Moderating the interest rates the way the Fed does is really a tool to help dampen that inflation, and we got a little bit of that today. The ISM non-manufacturing, the survey of the services side of the economy, which is the much larger component of the economic activity, moved back above the 50 mark after a brief dip below, moving to 53.8 versus the expected 510. The new orders component improved to 54.1 from 53.2, but the prices reading remained elevated at 58.1, easing slightly from 59 before. So what does that mean? The analyst writes, the service side of the economy continues to look solid, helping to ease concerns of potential stalling of economic growth from the market. But the Fed, that might push the Fed on the sidelines, right? So we've got manufacturing saying, okay, this is we're getting a slowdown in manufacturing, but then we're seeing services still being robust. That's again why I don't think we're going to see any kind of rate cuts probably before next year. We had a labor report. The U.S. economy added 272,000 jobs in May, well above the estimate of 190,000, and up from 165,000 jobs added in April. The unemployment rate, which is derived from a different survey than the jobs numbers, rose to 4%, above the expected 3.9%. Average hourly earnings rose 4.1% year over year, and that is also above expectations. So salaries are going up, strong jobs, but we also saw an increase in unemployment. The report bucked the recent trend of weaker economic releases, and we never want to make too much of one report, the analyst writes, but the rise in earnings and gain in jobs likely means that a July cut, which has been increasingly expected by investors, is unlikely to materialize. There's just no way. I don't see any, believe me, I am not an economist. I'm a financial planner. But I just don't see any way that we're going to have any kind of rate cut in July. As I said, I don't think we're going to see anything before the end of the year. Anyway, well, what do we have this week? We talked about the CPI already. Also today, we're going to have the Fed decision. So we have the CPI report, then we get the Fed meeting. The Fed's going to tell us, are we raising rates or staying the same, or are we cutting rates? I expect that we're going to stay exactly the same. Thursday, we have the Producers Price Index. So we're going to see a different look at inflation, and this is really the measure that the Fed really tends to look at over CPI. So on to other analyst reports. One of our old friends is back in the mix today. I liked this report that they did. Our friends at Riverfront. I don't invest with Riverfront. This is not a recommendation to invest with Riverfront. Riverfront is a group of individuals that broke away from Wachovia, and I had the opportunity to work with these folks while I was at Wachovia. A bunch of bright individuals, but they're a money management firm, and they have very good analyst reports. Again, we don't invest any of our clients' money with us. Doesn't mean that you shouldn't. It's just that we don't. Again, that's not a recommendation. So they write, no bubble yet, how the current market is different from the 1990s. I hear a lot of people talking about the 1990s. Sometimes you compare these markets to the Great Recession, or there's a lot of comparisons out there. But let me share this report with you because I thought it was interesting. There is a common saying that history doesn't repeat itself, but it rhymes. This adage rings particularly true in the world of investing. With every bull market, prognosticators point to how past rallies have ended to predict what will eventually impede the current one. And while it's true that each bull market eventually ends, understanding company fundamentals can make a huge difference in determining when to head for the exit versus when to stay invested. They write, in comparison to our current market rally, we believe it is the bull market of the late 1990s that investors seemed infatuated with. In this week's review, they talked about the portfolio manager. He's going to demonstrate how these two markets rhyme with one another, but also make our case for why we do not believe we are on the verge of a bursting bubble. So I'm not going to read the whole report to you. I promise you that. I just wanted to read the preamble. But the key takeaways are this. Both today's and the 90s rally were technology driven. We're seeing that, right? And NVIDIA, Apple, Google, you name it. We're seeing these technology stocks, technology positions that are driving the markets. However, today's multiples aren't as stretched and cash flow is more abundant in our view, and we do not believe the stock market is in the late stages of a bubble. So interesting take, because it can certainly feel that way. Our friends at BlackRock, what do they say? They say what we're watching in 2024 elections. So this is from their election primer. They write, we stay overweight U.S. stocks ahead of the election, yet are cautious on bonds given the fiscal outlook. We focus on long-term positives in India and Mexico. So they're heavyweight or overweight U.S. stocks, and they're concerned about bonds. Primarily, they go on to write in their research report, they're concerned about bonds because of our deficits and our ability to pay our bond rates. We've seen struggles in auctions. There are some real struggles in the bond markets for sure. And they talked about the week ahead. So this was from Monday, and they talked about the Federal Reserve meeting and the CPI report. We already got half of that. All right, it is time now. Okay, here we are. So it's time now for our Financial 15. If you're just joining us for this portion of the webinar, you can, if you haven't already, hit the like, subscribe, and notification buttons so that you never miss an opportunity to see a new video that comes out or to even chat with us during the live videos. In our Financial 15 today, we're going to talk about the ability to choose your retirement tax rate. I often use this analogy. During the pandemic, I was driving an F-150 pickup truck. I still drive one today, but this was a different one. And I was at Costco getting gas. So I get my gas from Costco because it's cheaper, and I'm leaning up against the truck, pumping it in. And at the time, I was paying $1.85 a gallon. So I don't know where you're hearing this from, but $1.85 a gallon is much less than what gas rates are today, gas prices. So gas prices are, somewhere around $4, and if you're in California, it can be much higher than that. But I remember thinking to myself, if I could buy all the gas that I'm ever going to use during my lifetime at $1.85 a gallon, I would do it right now. Give me that contract. I would sign up for it. Forget about storage, spoilage, all that stuff. I understand that. But fundamentally, I'm thinking, well, at the time I had oil heat in the house. Geez, check that one off. I'll buy all that now. And let me be able to fill up my gas tanks for the rest of my life. I would have signed up for that. Folks, that is the situation we have right now with our tax rates. We are pumping gas at $1.85 a gallon for our tax rates. We're in the lowest tax rates that we're ever going to see during our lifetime. Certainly. I know people say, and many of you heard this already, that whether you're in the class or the YouTube webinars, you've been told year over year, maybe 30, 40 years of your planning experience, that you're going to be in a lower tax rate in your retirement. No, I really haven't met that person yet. So even if taxes somehow magically were to stay the same, you're likely to be in a very similar tax bracket. But the reality is that tax rates have to increase dramatically in the future, probably by about 2030, and we're going to talk about that in a moment. But in addition to that, you have things that you want to do during your retirement. And then you've got the government at a certain point who's going to tell you exactly how much you have to take out of your retirement plan, out of your IRAs. These are called required minimum distributions, and you can't say no, because if you don't take them, you're penalized up to 25% of what you should have taken. And you might think that that's a lot, 25% of what you should have taken, but it used to be 50. The penalty used to be 50% of what you should have taken from your required minimum distribution or from your IRA in the form of required minimum distribution. So the IRS is even giving us a break on that. Aren't they great? Well, we know that taxes have to be much higher in the future. But first, we're going to look at current tax rates. So let me get my pen here, and I'm going to reposition my whiteboard while we're talking, and we're going to talk about current tax rates. So follow along, folks. Here we go. All right, I'm gonna draw on this whiteboard. Now let's look at, these are tax rates as we are today. You folks that are on here every week have seen this chart 100 times. You probably have it already, and if you don't, you can go to attleborowealth.com and you can go to the resources section, drop down to where it says the slot corner, right? Resources slot corner. You scroll down and you can download this chart I'm sharing with you. No cost. You put in your email address and you'll be able to pull that down. So here are our current tax rates here. Everybody can see that, right? So it starts at 10, goes to 12, 22, 24, 32, 35, 37%. The important thing to note here is not only just the marginal tax rates. Most of middle-class America lives right about here, 22 and 24. Married filing jointly and single filers. This is risk number one when we're talking about tax rate risk. Tax rate risk means taxes being higher in the future. If you go into retirement as a married couple, you're not going to be there forever. One of you is going to pass away before the other. That is reality. If you haven't considered that already, it's time to. And many people don't. We know statistically that the older we get, the likelihood of both spouses passing at the same time is it gets greatly diminished, almost to nothing. But you don't think about it when you think about financial planning, tax planning, and relation to finances. But what happens when you're suddenly single? Your spouse passes away. Well, you suddenly get into this single filer category. So even if taxes miraculously stayed the same, your threshold for the top of the 22% bracket, for example, goes from $201,000. Right? You can have taxable income up to the top of the 22% bracket at $201,000. It drops all the way down to $100,000. Or if you want to just focus on the 12% tax rate, well, you can earn up to $94,300 for 2024 for taxable income as a married filing jointly taxpayers. But as soon as one of you passes away, that drops down all the way to $47,150. So just by losing your partner during your retirement, your taxes are likely to increase dramatically, because where you would be paying taxes at 12%, you can see just earning $50,000 a year brings you up as a single filer into 22%. So that sounds bad enough, right? So we've got that risk. That's tax rate risk number one. One of you is not going to be here forever, but one of you is going to pass before the other. Tax rate risk number two is we've got a lot of pressure from the federal government. So we're going to talk about some of those. So follow me over here. So we've got a couple things. So we talked about this a few weeks ago, but this is the Social Security and Medicare Trustees Report. So this comes out periodically, and this came out just a few weeks ago. And that report told us that Social Security runs out of money. Let me get a different pen color here. I'll make it red. It runs out of money in 2033. Medicare runs out of money in 2036. So these shortfalls, so what does that mean? The trust funds are depleted. The trust funds are depleted, and then only a certain percentage of benefits can be paid. So that's a 21% cut in Social Security benefits and 11% cut in Medicare benefits. That's going to affect 70 million people for Social Security and 82 million people for Medicare. Nobody's accepting these pay cuts or benefit cuts. Nobody's accepting that. So something has to be done to fix this problem. Now, it should be done now, but there's no courage in Washington to change these things now. So it's probably going to get kicked down the road for a long period of time. And that's probably going to be early 2030 or so. 2030, 30, 32, 33. It really all depends on the continuing data that comes in. Now, let's add to it national debt. So this is a snapshot that I took just a few minutes before the webinar today, because this clock here, you can see this at the usdebtclock.org. These numbers move so quickly that you can't even keep up with it. So I just took a snapshot to share with you folks, but that's $34 trillion, almost $35 trillion. And the last calculation I saw was that we spend about, or this year we'll spend about $870 billion in interest. And the reason that is first of all, this is a huge number, right? $34 trillion is a huge number, and it's just compounding on top of itself because we can't manage our finances well as a nation. And it's not a political statement. It's both parties. Both parties, everybody involved is doing a terrible job when it comes to financial management. So we got $870 billion of interest to pay, and that is because, not just because the national debt has increased and continues to increase, but because the interest rates have increased so much. So we went from very low interest rates for a long period of time, and the debt kept clicking, but the interest on the debt wasn't bad, and now we're averaging more towards normal. So we're going to start really feeling the debt, and in fact, we're already feeling that. So knowing all of that, I look at it this way, and this is not my chart. I stole this chart with permission from my friend David McKnight because I saw it as part of his presentation, back in 2016 at one of my Slott training events, and I really liked it because it made sense to me. But it looks like this. If we go at 2024, these are revenues coming into the federal government, and revenue equals tax. And if we're, again, here at 2024, these are expenses that we have to pay. And we're talking specifically about Social Security, Medicare, and interest on the national debt. So we're just going to say interest, INT for interest. Now we know if we go back over here, I'm just going to capture two dates. I'm going to take 2033 and 2036, and let's put them on the plot here. And let's give them some grace here. We're going to put 2033 here, and we're going to put 2036 here. So what you're seeing is maybe they should be up here. It's the same timeline, but we'll put them up here on this curve. So whether it's revenues or whether it's expenses, they're on the same timeline. But you have revenues declining. Why are revenues declining? Well, because we've got this huge flux of baby boomers who are coming into retirement, and that's a significant amount of people who are paying not payroll taxes. And there might be a gap in the time that they're paying from when they're paying payroll taxes or and not have to pay their required minimum RMD tax. So we've got projected decreases in revenue and higher expenses, just in the form of Social Security, Medicare, and interest on the national debt. So at some point, there has to be a point of no return. And we think that that's probably around 2030. And we've done studies, and we've looked at studies, and if we know that the existing tax rates look like this, I just shared them with you a minute ago. Start at 10, 12, 22, 24, 32, 35, and 37. I made an extra one. Let me make sure I got them all. 10, 12, 22, 24, 32, 35, and 37. Yes. So there are current tax rates under the Tax Cuts and Jobs Act. So these rates are set to expire 12/31/2025. 2025 is going to be a huge tax reform year, probably. I don't know what it's going to look like, but here's what has to happen. We should be thinking about, okay, we've got a problem coming down here. We can't cut benefits for Social Security. We've got, what was the number there? 70 million people who will or are receiving their Social Security benefits. They're not going to take a 21% cut in their Social Security pay. We've got an 11% shortfall in Medicare for 82 million people. That's not going to be accepted by the people who are expecting their Medicare benefits. So something has to happen. And we think that something that has to happen is about 2030. But the problem is, should it be starting to happen now in 2024? responsibly, it should be, but Washington has no courage. So what they're likely to do is continue to kick the can down the road. And let me comment on what I just said about Washington has no courage. Washington has no courage because we don't allow them to have courage. Anytime a legislator stands up and says, I'm going to make changes, I'm proposing changes to Social Security, all folks hear is they're going to take away my Social Security, and that person is likely not to be elected. So the only way that this can work is that if both sides come hand in hand to the table in front of the TV cameras and say, we're working on this together and we pledge not to kill each other over it, but politically kill each other over it. So I don't know. I don't see that happening anytime soon. So that will probably be pushed until the 12th hour. Now, it's easy to say, well, they're going to wait till the 11th hour, but let's say that, history has shown us in recent years that whether it's debt ceilings, whether it's other financial disasters really in front of us, that they wait till the last minute to extend debt ceilings, to make any changes, to pass budgets. So it's likely, knowing that we're probably going to be about 2030 before we see any significant tax reforms or tax increases. So what does that mean? That means that we still have time and tools and resources to take advantage and lock in these existing tax rates. Well, maybe not 32. Let's go back. 22 and 24. This is where most of middle-class America lives, right around that 22, maybe. I think the average effective tax rate for most middle-class America is about 18%. Our studies show that 18%, when we see the tax increases, when we fund these revenues enough to fund what we need to, when we increase revenues, let me say that the correct way. When we get to the point where we're increasing revenues enough to fund what we need to, what we've pledged to, not all the extras, just paying the credit card bill, basically the national credit card bill. The studies show us, and our studies show, that your average middle-class American is going to be in the 40 to 50% effective tax rate. So instead of 18%, you jump to 40%. Instead of 20% or 24%, you jump to 50%. That is the real future of our tax burden. So if you think about it, go back to the pandemic. Go back to 2020. Go back to pumping gas into your truck at $1.85 a gallon, knowing what you knew today. If you're able to lock in those rates or lock in those prices at $1.85 a gallon instead of paying $4 or plus today a gallon, wouldn't you do that? Well, you have the ability to do that. You have the ability, the tools and resources to do that through things called Roth conversions. The idea is you want to lock in your tax rate for your lifetime plus 10 years or more. What do I mean by your lifetime plus 10 years or more? Again, this came from my friend and mentor, Ed Slott. Ed was talking at one of the events, and he said, under the current tax codes, you can lock in your tax rate for your lifetime or 10 years. So what is he talking about? We know that if I do a Roth conversion today, so Roth conversion is simply, here's your tax deferred bucket, tax deferred, and here's your tax advantage bucket, tax advantaged, and we're talking about Roth IRAs. You can, via conversion, move money from your tax deferred bucket to your tax advantage bucket. They're the tools the IRS gives us. It's really that simple. There are two ways to get money to Roth. One is contribution, and two is conversion. So we've talked about Roth contributions before. We've certainly talked about Roth conversions before, but Roth contributions have some limitations and requirements, and I'm not going to go into that right now. Today I'm talking about conversions. There are no guardrails. There are no speed limits on conversions. If you have $1 million over here in your tax deferred bucket and you want to convert it all in 1 year and take that $1 million and plop it over here, you can do that if you want to. You're going to what? You're going to pay tax along the way. So if you assume a 35% tax on that, or 30, let's bring it down to a 30% effective tax rate, you're going to pay $300,000 in tax on that. That's probably not what you want to do. What you can do is you can schedule a ladder or a schedule of conversions over the next several years. We probably have at least six to 8 years, maybe on the outside 10 years, but 6 to 8 years to get this job done. Tax years, including 2024. So instead of transferring $1 million all at once and paying a higher than necessary tax rate, what if you came up with a schedule or a ladder or whatever you want to call it, and instead you transfer it over a period of time, over 5 years, 4 years, 6 years, 8 years, whatever works for you, and you choose your tax rate, because you get to choose. You say, in this year, I'm going to push up. I'll just draw it again. I'm going to push up, for example, into 10, 12, 22, 24, 32, 35, and 37. I'm going to push up to the top of the 22% bracket. And we know that today, I hope you can see what I was just doing. We know that today, the top of the 24% bracket is $383,900. I'm sorry, we're going to push up to the top of the 24% bracket. And that's $383,900. So you could say, okay, I'm pushing to the top of that. And maybe for you, it's the top of the 22% bracket, and that's okay. And let's go back. That is $201,050. So $201,050. So either one that you choose or either one that works for you is your choice. So you can choose, okay, I'm going to pay my taxes at 22%, or I'm going to pay my taxes at 24%, and you're never going to pay tax on that money again. Because once it transfers over to this bucket, to the Roth bucket, and let's just say it's not $1 million. Let's say it's $250,000 that you transfer over, or maybe it's $150,000 if you're trying to stay below the 22% bracket or within the 22% bracket. But you pay tax on that along the way, and you can pay it. If you're over 59.5, you can pay it via withholding. If you're under 59.5, you'd have to pay it out of your savings, other savings or investments or earnings, and that would come from the taxable bucket. But once the money's over here, it's never taxed again. So you, in fact, have chosen your tax rate in your retirement. You've said, this is me. I'm at 22%. I've chosen 22% for my tax rate in retirement. Or I'm at 24%. That's my choice. That's my tax rate in retirement. Some people with more money in their IRAs, some people have much more than $1 million in their IRAs. Sometimes it's 3, 5 plus millions of dollars in their IRAs. Sometimes they go up into higher tax brackets, 32, 35, 37 is rare, but sometimes we see it. But isn't even 37 better than 40, even if it just goes up to 40? Yeah, 3% is better. 3% is cheaper. 37 is less than 40. But if you've got $3 to $5 million, you're probably going to be in a much higher tax bracket, maybe 50 to 55. Listen, these recommendations that we're seeing are not cheapest at all. We're looking at significant increases. So you can certainly choose your tax rate in retirement, and you do it simply. The first step, figuring out your Roth conversion. So there are other things you could take advantage of. Cash value life insurance, if you're funding money, especially from your taxable bucket. But today we're talking about choosing that tax rate using Roth conversions. But let me expand on that a little bit. Because we can do Roth conversions out of this bucket, and we can convert as much or as little as we like. But can we do Roth conversions out of this taxable bucket? The answer is no. What if you have $1 million over here? Well, you can look at sending that into a cash value life insurance policy. That acts like a Roth IRA from a tax perspective. There's other requirements around life insurance that you should know about, but that helps you fund money from your taxable bucket, because this will be taxed as either ordinary income, like the tax deferred bucket, or as capital gains. So the most recent recommendation out of the Biden administration for the increase in taxable gains was taking it from the highest at 23.8% to the highest at 44.6%. So, folks, 44.6% is much higher than 23.8%. So I've talked about that in the past few weeks. I don't think that tax recommendation or the proposal is going to go through, but that's some of the thinking that's coming out of Washington, so you should be aware of it. So you want to shift as much as you can from this side of your ledger, the taxable and tax deferred, to the tax advantaged. You choose that tax rate, whether it's capital gains rate at, capital gains rates now are at 0, 15, or 20%. And then depending on your income level, you can add on another 3.8%. But still, even if you're at the total of 23.8%, and even if the last proposal, as I told you, was to increase that to 44.6% for high income earners. But let's say they just increased this to ordinary income tax and it comes in at 37%. Isn't 37% less than 23%? Yes, of course it is. So you're locking in that tax rate for your lifetime plus 10 years in the case of an IRA, and really just your lifetime for your taxable bucket. And it could be longer, right? It could be 10 years or more, because if you first transfer it to a spouse, then that's I'm talking about your IRA. If you first leave your IRA to your spouse can continue that as their own IRA, and then they can pass it to their heirs. And then currently, under the current tax code, that 10-year rule could apply. So it's simple, right? Convert to a Roth IRA, potentially fund cash value life insurance, but it's not easy. You, of course, have to develop a financial plan around this. You have to review that plan every year. You have to be very, very detailed in your financial plan. It can't be a simple kind of one-page financial plan. It's got to be an in-depth financial plan. It considers your expenses, your tax situation, your assets, your income, all those things. There are many considerations, not just tax. Of course, tax is one of the considerations. How much tax can you pay, or how much tax do you want to pay in any given year when you do these things, these conversions, these liquidations? You got to consider the tax. You got to consider other things that are triggered by these things, like IRMA, increased Medicare costs by the income-related monthly adjustment amounts. I did a whole video about IRMA. So here we go. I'm going to write that down. IRMA. You've got to look at the effect of tax credits, because you might be counting on a tax credit like an EV credit or something like that. And then if you do a Roth conversion because your modified adjusted gross income is too high, then that tax credit goes away. You have to be concerned about cash flow. Can you afford these things? I want to pay the tax either out of my withholding or out of my taxable bucket. How is that going to affect my cash flow for the things I want to do, either now while I'm working or in retirement? And there are other considerations to take into account. Your charitable inclinations, your gifting inclinations, your estate transfer. There are a lot of things to consider. So it is simple. We're converting from the tax deferred bucket to the tax advantaged bucket, Roth IRA. We're transferring money from your taxable bucket to a cash value life insurance policy. Very simple concept, not simple application. Simple but not easy. Timing. I was speaking to somebody yesterday, and they said, well, I've got time. I've got time to consider this, and I want to do some Roth conversions. I want to do whatnot. I said, that's great. Don't let another tax door close, because this person in particular had been planning on Roth conversions for the last several years. I think 3 or 4 years have gone by and they haven't acted because there's a lot to consider. So it's not a criticism. It's a lot. It can be overwhelming. You could do too much. You could do too little. But don't let another tax year close. What do I mean by that? If we go back to this, you think of it this way. So between 2024 and the needed tax change here at 2030, we've got a few tax years left. Once that tax year closes, once the 2024 tax year closes, 1231 comes and goes. For this year, you can no longer do a Roth conversion. You can't do it for 2024. That's done. That door's closed. Then once 2025 closes, that door's closed. You can't retroactively do it. You can do a contribution retroactively up to the tax filing deadline, but you cannot do a conversion retroactively, which you could, but you can't. So once these doors close, you're done. We get to the point where those tax law changes have happened. You've got higher tax rates. Gas is not as cheap as it used to be. You can't buy it anymore at $1.85 a gallon, you're going to look back, you're going to be at a much higher tax rate, and you're going to say, geez, I wish I would have acted then. I've never had a person sit at our table or across from the webcam and say to me, I wish I would have waited another 5 years to do this. It's always the other way around. It's always, geez, I wish I would have done this 10 years ago. I wish I would have done this 5 years ago. So don't wait. Don't wait. Take the steps to act now. And that is how you choose your retirement tax rate. You can do it. It is simple. It is not easy. It is actually quite complex, but you can do it. Don't look back and say, I wish I would have. Take steps today. If you need help with that, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. And if it makes sense for us to schedule a 15-minute phone call, you and I will have a 15-minute phone call. We can work through what your ideas, issues, progress may look like. I'm happy to do that. If you want more information or want to look at past videos, well, you can certainly find past videos on our YouTube channel. I would appreciate if you subscribe, like, and hit the notification buttons on our YouTube channel. Feel free to browse. We've got over 200 videos now. We've been doing this for more than 4 years. We've been doing almost weekly webinars every 4 years to bring, or every week over the last 4 years to bring you this content. You can find out lots of other information on our website at attleborowealth.com. I hope that was helpful for you. I hope it inspired you. I hope I made it a little simpler for you, maybe. Tax code's very complex. These rules are very complex. You have to find a person that you're comfortable with. I talk a lot about our retirement team. And geez, I just said it, so I'm going to include the video. So you've got to put together your retirement team, but don't be afraid of thinking of things differently. Pay attention to these things. We are in the lowest tax rate that we're ever going to be in. If you're a married couple, you've got more risk than a single filer because you're going to have that drop. You have greater opportunity as a married couple than you do a single filer because your bands are higher, right? The top of the 24% bracket for you as a married filer is $383,900 compared to $191,950, which means as a married couple, you can shift more money from your tax-deferred bucket to your tax-free bucket or your tax-advantage bucket, as the regulators like to call it. So take advantage of these things while you can before the door closes, before, unfortunately, something happens. And if you need help or if you have questions, reach out to us. We're happy to have that conversation. I hope you have a great week. I'm really happy to see you all. I've missed you. And that's it for today. Take care. Bye-bye.